Welcome to TheoTrade. This is Don Kaufman. It's June 30th, 2018. You are watching the Theo Weekend Update. Let's get started. A brief review of some of the action of this previous week. But primarily, during the course of this video, we're going to talk about moving forward and really getting specific. We're going to be talking about what we term outlier trades. So one of the things I want to start with, and again, this isn't kind of a brief review, happens to be specific to the SPX. For those of you that know, on a week-to-week basis, we discuss expected move quite extensively. Well, this previous week, the expected move was $36. The irony, and not a lot of people caught this, but the markets faded heavily on Friday. For those of you that do not know what that means, it means we sold off into the close after having a wild rally earlier in the day. Nevertheless, we faded directly and spot on in the SPX to 2718. That happened to correspond to the penny to the edge of the expected move. So really what the summation of that is the expected moves are very much being traded in and around. We'll explain that a little bit more. We kind of come to the charts here in just a few moments. Another major thought from this previous week, okay? Let's not talk about, the action that happened. All right, we sold off a little bit, we rallied, we laughed, we cried. Specifically, we want to talk about how can you make money in this? And one of the ways that we were extremely successful, and this last week was huge by huge, happened to be in net buyer of options. Now, I talked about that on last weekend's video, be a net buyer of options. What does that mean? Again, there's a lot of blanket statements out there. You should always be an option seller. You should always be an option seller. Okay, right now, we want to be a net buyer of options, specifically in the very short duration. Why? Because the options marketplace, specifically, when I talk about the options marketplace, I'm talking about implied volatility. Implied volatility is still inherently low versus the actual move. So we're talking about like historical vol versus implied vol. But the bottom line is this: the market itself, okay, in equity products, in most of the index products, the market itself is moving drastically more than is being priced into the options market. And to give you a couple of examples, and again, I can show you some of these here in just a few minutes as we get over to the charts, but we had a day earlier this week, we went out and bought some SPY options that were going to expire. Specifically, it was on Wednesday. The options, we bought some puts for 65 cents early on in the trading day. Literally blindly bought them. You know what? You got a 50-50 chance. They were the at-the-money options. Just assume that you have a 50-50 chance. You buy these at-the-money options for 65 cents. Those things went out just before the bell. We closed them for over $3. Think about the risk reward in there. You have 65 cents at risk to be able to make what? $2, $3? Who wouldn't want to do that trade even if it is a 50-50 bet? Now, that's one of the extremely important points I wanted to make, again, from this previous week. Nevertheless, moving forward, well, the volatility in the options market is starting to pick up, and that's something, again, I'm going to explain. Now, this is a little bit more, again, moving forward into this next week of trade. So we're coming into the July 4th holiday week. Now, nobody expects a lot of volume, but you should expect some action in the marketplace. Why? The SPX, again, in the previous week, had a $36 expected move. In this coming week, now remember, there's a holiday in this coming week. We're going to be closed on Wednesday for the July 4th holiday, right? Coming into Tuesday afternoon, everybody hits the Hamptons. On Wednesday, Thursday, they're probably still in the Hamptons. Yeah, then why is there still a $42 expected move in this next week of trade? So again, the previous week, $36 move, but that was 5 trading days. This coming week, we have 4 trading days. We have a $42 expected move, and it's a holiday week. It's a little bit baffling, but all of a sudden the implied volatilities are really starting to pick up, which again will bring me to one of my key points when I do hop over to the trading application. One of the key points, we are going to be looking for what we term outlier trades. And again, I'm going to make that statement very, very clear here in just a few moments. Okay, a couple other points that I want to happen to make. Here we are again on a Saturday morning, and as I'm recording this, an article comes out a few minutes prior, and the article that came out was from Bank of America Merrill, and they actually said that this past week there were $30 billion in outflows, the second largest ever recorded in history. But now if you look back at the marketplace, you're like, whoa, 30 billion came out of this thing? Where did it go? Did it go to money markets? Did it go into the bond market? Sure, a little bit here, a little bit there. Predominantly, though, they were actually rotating capital, okay, from funds back to money markets, but money was still, at the same time there's a $30 billion net outflow, okay, from funds, there was actually still money being put in net positive into technology. So in effect, what we have is we have a handful of major tech stocks, especially at the end of the quarter, because they call it what's window dressing. That is, dress up the portfolio at the end of the quarter. That's what a lot of portfolio managers will do. But there were net inflows to technology. But net, there was still 30 billion that flowed out of the market. It's, again, a little bit of a catch-20. But right now, there's so much capital and so much market cap pushed into technology that it's masking, okay, the larger weakness of the entire marketplace. I'll give you specifics. We're going to look in a moment at the XLF, the financials. I mean, the financials are under absolute duress, down big right now on the year. Okay? We're 6 months through the year. This is it, people. We're halfway through. The financials are getting whacked, and that's one of the key signs. In fact, the financials closed on an absolutely key level. However, all of this is being masked. As long as we buy Apple and we buy Amazon, we shove a little bit of money into Facebook, spread it around with some love in Google, okay? I mean, again, you have the same 5 underlyings. Please, I didn't forget Microsoft, did I? Spread the love into Microsoft as well. You have the same 5 underlyings, and their market caps are masking the broader weakness in the marketplace. With that, let's go to the charts and take some detailed looks. All right, to the charts we go. Let's start with a quick look at the SPX and, of course, more importantly, some of the expected moves inside of the SPX. Okay, this is the previous week of trade, so we tumbled a little bit, but let's not get ahead of ourselves. Let's not get crazy over here. Listen, we had a $36 expected move. That's $36 higher, okay, or $36 lower. Guess what? We went down $36 on the button. Now, as I was talking about a moment ago, it kind of surprised me. Well, implied volatility picked up pretty considerably for this next week, considering this is only, again, a 4-day kind of week out there, but we're looking at a $42 expected move. Again, a $42 expected move, higher or lower. Now, people constantly kind of question the expected move, and I say, well, expected moves are very much in play right now. What does that really, what does that mean? And it has everything to do with the amount of liquidity that happens to be trading around some of these expected moves. And that is, there are tens of thousands of contracts that happen to be open for the Friday, again, expirations. You can open up in the SPX, go out, okay, to July 6th, which is of course, the end of the week. And it's very important to know that the SPX now offers Monday, Wednesday, and Friday. This next week, because there's no Wednesday, because that's July 4th, they've actually moved it to a Monday, Tuesday, Friday expiration. It's kind of fun, but there are literally tens of thousands of contracts, people, that trade in, and I'm just right now, and I'm just kind of zooming in, and you're like looking at some of the puts. Look at the open interest out here. These things, okay, are weeklies. And it's, again, you're looking at it and thinking like, okay, so why is he showing the volume and the open interest? And it has everything to do with the fact that the more you trade, specifically in the SPX, okay, the more you have to hedge. Again, the more you're going to have to hedge in those S&P futures, the more that the marketplace is going to be driven to the edge of these expected moves. Now let me show you on an intraday basis. By the way, yeah, this is yesterday's trade. This is yesterday's trade. Could you close any more on that line? That is the line, the expected move that we drew in the previous week. Now, speaking of the previous week, there were a few really specific things that I mentioned last week. One of them is we took a very detailed look at the influence of a number of major tech stocks upon the market as a whole, right? We looked at our Microsoft and our Netflix and our Apple and our Facebook, Google, but we really singled out Amazon. Why? Because Amazon, it owns the XLY. I mean, it literally is running the XLY. And this, I'll tell you what, the statements that we made last weekend couldn't have been any more timely because it shows the vulnerability of the XLY. Now, why am I mentioning the XLY? Okay, well, because we're going to be building a few trades, and we're going to be building what we term outlier trades. And I'm going to give you one example of an outlier trade, but then all throughout the course of this week here at TheoTrade, we will be building other, outlier trades. But in the XLY, let me explain precisely what an outlier trade happens to be and really how you could take advantage of it. First and foremost, pull up a chart. Any amount of time frame is fine. This happens to be the last 3 years. Now, we know the XLY, again, this is consumer discretionary, but this consumer discretionary, ETF, it happens to have a little bit of a weighting problem. What's its weighting problem? Well, the problem with the XLY specifically is that Amazon is equivalent to of 22% of this ETF, which is going to create a mass casualty of the ETF epic proportion if Amazon ever does start to have some sell side activity. Now, that's, I said, if Amazon ever starts to have some sell side activity. So getting outright short XLY could be, futility at its best. It could be a very, very difficult thing to do, difficult thing to maintain, because effectively in shorting XLY, the reason I like this one is, first of all, it's easier and much, it's a lower barrier of entrance than shorting, for instance, a $1,700 product that is Amazon. I think everybody would agree if you take a look at the Amazon chart and just compare that. Look at the Amazon chart. No reason to pull up side-by-side comparison. Then just take a quick glance at the XLY. You'll see exactly what I'm talking about. So I think that the barrier of entrance into the XLY is a much easier one. To explain what an outlier trade happens to be, well, it's pretty simple. I'm going out and I'm looking for 3 sigma kind of moves. What's a 3 sigma kind of move? Stuff that's going to happen that's going to take us here, or down here. If we actually flip the chart and we start to look at this little guy on a percentage basis, which we absolutely can do. We can put like a year-to-date percentage basis. We're looking for moves like right now, again, and I'm going to kind of circle this and highlight it. Right now, on a year-to-date basis, and again, this is the XLY. We are year-to-date, and we actually flipped everything to percentages. We're up about 9% year-to-date. If we get a move that's, jumps down, so we're like 6% or even, 3%, or even worse, that the product is actually down, for example, on the year, this is being like the zero barrier, the 0%. If the product is down on the year, well, absolutely knock it out of the ballpark. Now, we want cheap out-of-the-money trades, but you got an issue. All right. And one of the issues is, and we're going to go way out in time to describe this issue, and we're going to go, let's flip one of the columns over here to delta, the other column to what's termed implied volatility. Now, this is the kind of trades that, first of all, can pay off in a phenomenal manner, right? And I cannot stress that enough. But one of the things that you have to fight, and again, if you're going to trade some options, you have to look at what's termed skew. The at-the-money options are trading right around like a 15 vol. The out-of-the-money options are trading like all the way to 20 vol. That effectively means the further you go out of the money, the more the options are going to cost you, right? Because what's going on is, well, the traders are pricing in outlier trades. They're saying like, okay, this is the volatility here. This is at the 15%. But the further you go out of the money, no, we're going to charge you 20%. Now, we're actually going to offset some of that skew, using what's termed a risk twist spread. Now, the risk twist, it's a little bit of imagination, something we came up with quite a while ago. But here, I've already gone ahead and built me a risk twist spread out in the September expiration. And I'm going to cruise right over to the Analyze tab, and I'm going to show you a little bit about it. It's just to be conservative on time. We're selling a 107. And again, I'm going to take you through this trade a little bit. So we're going out there and we're selling, again, 1 contract of the 107s, buying 3 of the 103s, and then selling 1 of the 101s. Now, the reason that this ratio exists the way it does, it's a type of a ratio back spread, but the ratio the way it does and the strike increments are set up, designed expressly to offset some of that volatility skew that we talked about a moment ago. The entire trade is done for about an 82-cent debit. Could you lose more than 82 cents? Yes. However, we'll actually show you how you will not have what is termed the valley of death on this trade. And that's one of the most important things about really comprehending the trade is it's not just about putting a trade on, it's knowing how to manage the trade most effectively. And that's kind of what we do here, of course, at TheoTrade. If you've been through this risk twist class, this is the kind of trade I'm telling you that you want to be able to place right now, and not just on the XLY. Okay, this thing is wide open. So this trade, you're looking, by the way, when I say it's wide open, we could look at this in the spiders, we could look at this in the Qs, but right now, I think that the one of the best places to consider the trade would be specifically right here inside of the XLY. Let's look at some P&L, okay, and see, like, kind of in our little fictitious world over here, what we could actually make. If, for example, the XLY were to sell off by 10% between now and September expiration, it says that we would make about 400% on your money on the trade. That's partially true, but it's not adjusting volatility. Volatility is going to bump up by at least 10%, and this is really a long Vega trade, so you're going to make more like about 700%. Okay, so you're really starting to catch your stride with about a 10% move in the marketplace. That's why, again, I call it an outlier trade. Now, if you're thinking 10%, come on, Don, that's a big move. I tend to agree. I really do. I tend to agree. However, I want to show you on a percentage year to date. This is a year to date now percentage, and just take a look right up here. Right, it was up 25%, and all of a sudden in 1, 2, 3, 4, 5 trading days, all right, come on, thing already dropped like 5-6%. Who you kidding? 10% can happen, can easily happen, and that's the kind of trades that we're going to be looking for kind of moving forward. Now, let's go some other directions, okay? So these are the outlier trades. This is the stuff that you really want to focus on. All right, now, moving forward this next week, the XLF is in very, very serious trouble. This happens to be the financials. I can't reiterate this enough. Okay, the S&Ps can no longer go up if the financials do not participate. One of the most astounding things to me in the entire trading week, and I don't think a lot of people caught this, the entire trading week though, and this past week, I'm going to close up this left side bar because it's that important to display this. The entire trading week came down to this. Yesterday, Friday, okay, the banks, right, these are your financials, had their stress test results released. It allowed most of the major banks to do buybacks. It allowed them to pay dividends, right? Everybody gets a little bump in the old salary over there that works the banks, okay? The banks came out of the gate strong, really strong. We're talking they're up like 1.5%. They're taking off to the 27 level. We expected to be a ripping rally and faded hard, and they faded right back just north of 2650. Now, if you've not seen me discuss the 2650 level inside of this product, well, it's everything. This is what I kind of call hold the line. And if you haven't seen this before, again, that's close enough. That's once. There's twice. There's third time's the charm. Nope. The fourth time, here we are. 5 recent occurrences. Okay. And you have to recognize that the financials right now, they're in more trouble than they were in February. They're in more trouble than they were in March, April, May. Okay. June, looks like, again, the 5th time happens to be the charm in here. Now, I am not big into charts. I'm not big into support and resistance, but I am telling you that the financials are in dire trouble. This is the signal to sell the S&Ps. The question, okay, kind of looms is we're seeing rotations of capital out of the financials. They're still putting money into technology net, right? Net tech is still okay. However, we look at this as kind of the next shoe to drop, and that is specifically why we're looking for those outlier trades in technology. People, this is a lot to think about. And throughout the course of this next week, just because it's a holiday week, don't get off your game. Seriously, don't get off your game just because it's a holiday week coming in here. We're actually trading below 2731 in the S&Ps. Okay, the next major level to the downside is 2682. With that, I want to thank everybody. Have a wonderful weekend, and do join us live in the TheoTrade chat room throughout the course of this holiday week. Have a good weekend. Bye-bye.